Jamie Dimon is scared, and I mean very scared. Today, I want to go ahead and play you two clips, okay? The first one I'm going to play you is from 10 months ago, and the second clip is from yesterday, essentially. And the reason I want to play you these two clips together, essentially, is because Jamie Dimon shows how much his perspective has changed just in the past 10 months in regards to his feeling about the economy moving forward, maybe even his business moving forward. And this is a very important video we're going to get into here today, because it's not just about the economy and what might happen here and these sorts of things over this next year, right? This is way bigger than this. This is about identifying if companies you might own, right? Which Jpmorgan's a stock I own in my dividends only account. But if CEOs are clearly showing signs that they are much less confident about their business, about future business prospects and those sorts of things. And what you're going to see here is pretty darn shocking and pretty glaring. So hope you guys enjoy this one. Let me know if you do. It's a very different type of video, and I think it's important because we all are going to own companies, right? And we all are going to have management teams talk about the businesses every 3 months, obviously, when earnings come out, right? It's very important to kind of tell the difference between a management team or a CEO that is feeling very confident and not so much. So let's go ahead and play this. I'll stop it a few times, and you guys tell me if you can notice, wow, what a night and day difference between this man 10 months ago versus today.
Nervousness on Wall Street, stocks selling off yesterday as investors reprice equities ahead of the Fed's transition from easy money policies to tightening policies. There's also, of course, questions about the impact of Omicron and inflation on earnings. I interviewed Jpmorgan Chairman and CEO Jamie Dimon in the middle of all the volatility yesterday and got his views on the backdrop and what's ahead for the year.
I think the way to really look at it is first to look at the economy and then the markets. The economy, the consumer's in great shape. Obviously, there's some folks still suffering out there, but they've got a lot of money. They're spending 25% more than they did pre-COVID. Their balance sheet's in great shape. The debt service ratio's better than it's been in 50 years, literally. Home prices are up. Stock prices are up. Businesses.
Look at how, I mean, this man is like glowing with confidence, his facial reaction, obviously his commentary, right? His tonality is just exuding confidence.
You're doing quite well. You got plenty of money and plenty of confidence. So that economy's growing. The numbers are herky-jerky because coming out of the pandemic, it just caused a lot of uncertainty about people rejoining the workforce, the return to the office and inflation numbers and all that. But the economy is strong. I think the expectation should be we need a strong economy to justify asset prices. And obviously, when interest rates go up, people are going to reprice assets a little bit. So I just would expect that you're going to have a lot of volatility.
It was a lot more than a little bit, I'll be honest. Assets got definitely repriced, and it's still going on, and it's not done. Definitely being priced differently.
In the market this year, but you're going to probably have a pretty strong economy, which is maybe more important for most Americans.
Okay, now I want to play you a clip from this, and I'm going to go back and forth here, okay?
You know what's happening in markets. You know what's happening in the economy. You know what's happening with consumers. What do you...
Once again, this one's from yesterday, essentially. The other one's from 10 months ago.
Right now, I think everybody was concerned. What was it, 6 months ago when you said a hurricane is coming, you better prepare?
Yeah, so I didn't really say that. But let's just start by saying the United States economy is the strongest economy in the world today. So we should celebrate that a little bit. And that's why capital's coming here, business is coming here, is still growing. If you look in the short run, the consumer is spending 10% more than last year and 40% more than pre-COVID. They're spending it in different things. So all your speakers up here, some are doing better, some are doing worse. That's a tremendous sum of money. And they have $1.5 trillion still in their checking accounts, more than pre-COVID. So the spending is down. That's the good news. And
see how much different his entire vibe is, his entire facial reaction. So he's using some of the same talking points he was using, obviously, back 10 months ago. But his whole delivery it's like night and day difference. Like it's not even on the same wavelength.
Good shape too, by the way, and their balance sheet, consumer balance sheet is in great shape. The other news, which is not good, is that rates are now 4% on their way to 5%. Inflation is eroding everything I just said. And that $1.5 trillion will run out sometime mid-year next year. And so when you're looking out forward, those things may very well derail the economy and cause this mild or hard recession that people are worried about. But
ooh, mild or hard recession. Ooh, there's a big difference between a mild recession and a hard recession, I can tell you that. I guess we either get one. We don't get a medium recession. There's no option for that. It's either mild or hard now. Oh, boy.
Yeah, I'm glad you mentioned the macro story because you have an incredible vantage point on the consumer, looking at your credit card statistics. I want to get into that. But we saw 199,000 jobs created in the month of December. That was about half of what people were expecting. The conversation is about inflation right now. The Federal Reserve expected to raise interest rates. How do you assess the economy playing out in 2022 and beyond, given all of that?
I think people are over-focusing on monthly numbers, which are distorted by a million different things, and that I think that the table is set for a very strong economy. That consumer has a lot of money, and business has a lot of money. They're spending it. Confidence levels are going up. Jobs are plentiful. Wages are going up. I mean, it's...
By the way, confidence levels, just if anybody needs to get caught up on this, Michigan Consumer Confidence Index has been the lowest in 2022 that we've ever seen in the history of that index. It's been extraordinary. I mean, so little confidence, it's hard to even fathom how low the numbers have been.
It's pretty strong. This will be one of the strongest economies we've ever seen in 2021, and 2022 will probably be pretty good too. And obviously, the fly in the ointment is inflation. And, no one knows exactly how it's going to turn out. I've always thought it wasn't just transitory, or at least people wouldn't feel it was transitory by the end of the year. And, some people think it's embedded in the market. It's going to go down to 2.3% by the end of the year. I think it'll be a little bit higher. But, look, if we're lucky, the Fed will engineer that so-called soft landing and raise rates, facing a strong economy and employment coming down. There's always a chance they have to do it faster than people think. And we just don't exactly know. I mean, no one knows the future. And if you look at anyone's forecast, I mean, they almost never get the inflection points right. So, but I also go back and you look at in March of 2020, we were on our way to 15% unemployment. It could have been 20% unemployment. COVID was killing a lot of people. You remember being in New York City, how terrible it was. And we didn't have a vaccine. So let's count our blessings still. And, we're still getting through this thing. And hopefully Omicron may, we don't know about the future variants either, but hopefully Omicron may be the final one that makes this endemic.
So you can tell this is obviously from, let's call it the end of 2021, beginning of 2022, right? Because there was people still were talking about Rona. Now no one talks about Rona unless it's in regards to obviously China and lockdowns there and what's ever happening there. But obviously a very different time, whereas now all they talk about is inflation. All they will talk about in 2023 is the economy.
Yeah, there's certainly some expectation in that regard. But back in 2007, we were also looking at an uncertain market. You saw the crisis coming before many, and you started reducing areas with the most risk. Tell me about the risk around the Federal Reserve, going from an easing environment to a tightening environment. I mean, look, JPM and so many other financials benefited greatly from all of this liquidity. Do you see this as this liquidity about to go away? I mean, what happens now when the Fed raises rates and begins this balance sheet runoff?
Yeah, so it's very, very different in 07. In 07, the world was massively over-leveraged. Hedge funds, private equity, syndicated loans, some of the banks and investment banks, civs, banks globally. This is completely different. The world is not over-leveraged. You could say the government is, but the government has a whole set of different powers than the individual companies do, and consumers were over-leveraged back then. Today, now they're under-leveraged, so it's wholly different. So, and I also think liquidity had pluses and minuses for everybody. I mean, keeping rates low is terrible for banks. The recovery was obviously very good for banks and all of that, and very good for everybody. So, there was
this whole people aren't over leveraged, businesses aren't over leveraged. I don't know, man. I mean, there's so many companies that are extremely leveraged that are obviously money losers. I talk about a ton of those on the main channel here today, right? And obviously a lot of folks that have taken out massive auto loans, credit card loans, everything. And so I just don't know if I'm a full belief about this whole folks aren't over leveraged, nothing like that. I'm like, I don't know. I think a lot's changed over the last few years.
$1 trillion of global liquidity, some of which can have to be removed. No one should be surprised the rate's going to go up and that kind of monetary and fiscal stimulus, which is extraordinary, multiples of what the world's almost ever seen before. And it's going to be hard to figure out what it means when it gets removed. But in the meantime, jobs are plentiful, wages are going up, companies are healthy, consumers are healthy. And, the market's going to be volatile because they're trying to figure out exactly what you're asking me. And you know what? They're not going to be able to figure it out. You just have to live through it.
Okay, let's hop back over here now.
More important than that, by the way, is all the geopolitical stuff.
It's a big decision.
Wait,
Mild
you
and
said
harsh.
5%. You said 5%. You really think that's where rates are going to stop?
So she pulls up a good question here, Becky, quick, in regards to the 5% thing, and you think that's really where they're going to stop. He's going to give an interesting answer here. But this man, Sorkin, I think is his last name, he wanted to attack the whole, well, what about mild or hard? Because I think that was important. You hear what he said there?
You said 5%. You said 5%.
Yeah. Listen in the background.
More than that, by the way, is all the geopolitical stuff.
It's a big decision.
Wait,
mild
you
and
said
harsh.
5%. You said 5%.
There's a big difference between a mild and a hard. 100%, man. I mean, like, this is an important subject we should discuss, like, because, yeah, a mild recession is like, okay, let's go to sleep. A hard recession is a whole different game.
You really
man.
think that's where rates are going to stop? The terminal rate?
I think the Fed has made it clear they're going to get to 5 and stop for a while. I read a while as 3 to 6 months. That may not be sufficient.
You'd still go to 5 if
may not be sufficient. So meaning they might need to start raising rates again after that?
10-year stays anchored at 3.5, or you don't think it will? You think the 10 years headed back up?
I think that you have to look at the other risk we have is quantitative tightening. We've never had it before, ever in the lifetime of mankind. So I look at that as something we should be quite concerned about. And, the suppression of the 10-year bond rate has been going on for 20 years, and it can't really be suppressed anymore. And, QT has just started, so it's very possible. And if you have like 2% on inflation, you should have a 4% bond today. So I don't look at this like it's got to go get better than here. Obviously, it's a risk on trade. But that mindset may change if inflation sticks around a little bit longer.
Whew, I mean, just night and day between the way he was talking.
I was reading somewhere earlier that the stimulus was 25% of GDP. Jamie, how many rate hikes are you expecting?
I don't know. I rely on my economists. They're very, very smart, and they would probably say 3 or 4 this year. I would probably say a little bit more. Maria, I also want to put in perspective. Paul.
Now, that's important. You hear what he said there. 3 or 4, I'm expecting a little more, so maybe he was expecting 5, 6. But at that time, when people said a rate hike, what they were talking about is 25 basis points each time, okay? So meaning Jpmorgan folks, the ones he's looking at there, were expecting the Fed to raise rates 3 to 4 times this year by 25 basis points each time, right? So meaning by the end of the year, maybe we're at 75 basis points, maybe 100 basis points, somewhere around there. And obviously we're going to end the year somewhere in the 4s. So, I mean, that's just a huge difference. And obviously the Fed raised so much more aggressively than Jamie Dimon was expecting, and to be honest, than even the folks on all these big Wall Street banks expected.
Volcker raised rates effectively 200 basis points on a Saturday. To raise it 25 basis points, if it goes up 1% this year, I don't think that.
If it goes up 1% this year, holy smokes! If only we had that scenario, right? And when Volcker, when he talks about 200 basis points on a Saturday, the Fed, back in those days, man, the Fed funds rate was, 10, 15, whatever % back then. So it wasn't like 200 basis points was that huge of a deal. I can tell you 75 basis points recently, way bigger than 200 basis points was back in the early 80s. Way bigger. It's like night and day difference because of the rate of increase, essentially, as a percent.
In of itself has enormous economic effect. I think that all the borrowers that completely easy can handle that, particularly if you have a strong economy. So you can go to almost any company, higher sales is more important than slightly higher interest rates. And that's true for most things. And, housing, would be slowed down just a little bit by that, but housing is booming. So, hopefully the Fed can navigate these things, and but you're going to have to deal with higher rates. And people just get their heads wrapped around that. And by the way, they've been artificially low for years. I mean, even just a normal would be 3.5% in the 10-year bond and 2% in Fed funds. Just a normal thing. And, that we're going to return to normality one day.
Yeah.
Oh, Mr. Dimon, I'm from 10 months in the future, okay? We went way past normal, okay? Way past it, and did it way faster than anybody anticipated.
Yeah, that makes sense. Jamie, let's talk JPM for a moment. You had another great year last year. The investment bank on fire with all of the M&A, SPACs, all of the trading profits. But over the last year, we were questioning loan growth. It was not where many expected it to be. Go through the consumer and the commercial business, and how does loan growth look, and what do you expect for 2022?
Yeah, so I'm not I'm the opposite of it. I don't think loan growth by itself is a good thing. Loan growth is an outcome of decisions you make. But let me just separate the consumer from companies for a second. On the consumer side, there was plenty of loan growth in mortgages and a lot of payoffs in credit card. But that was because individuals were strong. Usually when loan growth goes down or negative, that's because people are over-leveraged. It's the opposite here. Loan growth was low because people had a lot of money and were able to pay off some of their, I think it was $150 billion of credit card debt, et cetera. And then also a lot of the loan growth on the mortgage side was refinancing, which is actually better for customers. On the business side, it's completely based upon their needs. And their needs are based upon growth. And think of inventories, receivable, CapEx. And so as we return to normal growth, their needs are starting to go up. And so you're going to see banks reporting loan growth numbers, and they're going to be better now than they were a quarter ago. But that's the outcome of a growing economy. And so you may very well, if I am right, you have good growth next year. Loan growth in the business side will probably return to normal. On the consumer side, it will return to normal. It just may take another 6 to 9 months.
Ooh, man. So that was interesting, just watching that, seeing not just his confidence levels and how much his demeanor overall has changed, right? And his, obviously delivery there, but also, geez, I mean, it just shows you how wrong Wall Street's been, obviously, this entire year, right? I mean, I think everybody's been wrong, to be quite frank. But, I mean, these are supposed to be the most sophisticated folks out there, right? The folks that are running Jpmorgan. And it's not like their belief is much different than what Goldman Sachs' belief was, and Bank of America, and Wells Fargo. I mean, people were talking about, by the end of this year, we'd be at maybe 75 basis points, maybe 100 basis points, maybe 125 basis points. And here we are going to be at 400 basis points, if not more than that. Just incredible how different everything ended up turning out to be in 2022.
You said geopolitics is really the issue that we need to watch.
Yeah. So you have this economy, but then you have oil, food, fertilizer, war, humanitarian crisis. We've not had a war in Europe like this since 1945. Right. And back then we said never again. And it's again. And then, of course, it's causing all this people rethinking secure lines and China and trade. And this is a lot of geopolitical upheaval. And add to that, by the way, there are a lot of emerging market countries that a lot of people don't focus on are going to pay a heavy price because of the strong dollar, higher rates, and higher oil prices. And so that stuff is really significant. I don't think we've seen that kind of turmoil in the global world for a long time. And what I said about a hurricane, I said that's storm clouds. That could mitigate. It could be a hurricane. We simply don't know. And I think, as a risk manager, I prepare for both. But I'm not guessing which one's going to happen. I simply don't know.
As a risk manager, which one looks like the more likely scenario?
I don't know. So I put that whole mix of stuff and turmoil to be worried about. And we need great American leadership to resolve those issues. And so that's the most important.
So he's so scared that he doesn't even want to take any side there. He's like, I don't know. She's trying to press him on, what's coming here, the hurricane, right? This hard recession we're talking about, or is this like a little baby mild recession, right? He's like, I don't know. I want no piece of that question. He's like, and it's, I think, very telling in itself, right? And so it's just interesting to see that change. Now, keep in mind, right? He can get even maybe a little more bearish over the next few months and things like that. But do keep this in mind. People's opinions can change rather quickly, right? So let's say he gets even a little more bearish, right? And, a few months from now, and they do another interview with him in January, right? And he's even more in a bearish stance in this interview, right? Well, do keep in mind, a year from now, from that, he could be very bullish again. So you got to understand, like, people's whole perspectives can change upon a ton of different various factors, right? And it can go from super positive to all of a sudden, like, not so positive to positive to, so folks, obviously, opinions, perspectives change over time, and it'll be interesting to see where things are at in a year from now. Maybe we'll do another Jamie Dimon update come that time. Hope you guys enjoyed this video here today. This is definitely a different type of video than we've ever done on this reaction channel. Thank you, everybody that subscribed to this channel. I hope you got good value out of this one. Appreciate you. I'd love to hear your opinion in the comment section. Much love, and have a great day.